This is Sovrun, your guide to financial literacy. Today we're solving the ultimate trading dilemma. How much should you bet? In 2024, prediction market whales on Polymarket sized million-dollar election bets using one formula. Meanwhile, FTX collapsed because they ignored it entirely. The difference between getting rich and going broke? It's called the Kelly Criterion. The Kelly Criterion is a formula that tells you exactly how much of your money to put on a trade based on how strong your advantage is. Think of it like the gas pedal in a race car. Press too lightly, you'll never win. Floor it the whole time, you'll spin out and crash. Kelly finds the sweet spot, the exact pressure that gets you to the finish line fastest, without losing control. Here's the formula. F star equals B times P minus Q all divided by B. Let's break that down. F star is the fraction of your bankroll to risk. B is your odds, how much you win relative to what you lose. P is your win probability, and Q is your loss probability. Let's say you win 55% of the time on even money bets. So B equals 1, P equals 0.55, Q equals 0.45. Multiply B times P, that's 0.55. Subtract Q, 0.55 minus 0.45 equals 0.10. Divide by B, and you get 10%. Kelly says risk exactly 10%. So how does 10% compare to the real world? Conservative traders risk about 1% per trade. Standard institutional desks, about 2.5%. Half Kelly, which most professionals actually use, is 5%. Full Kelly sits at 10%. And anything above 20%, that's the danger zone, where even a winning strategy eventually blows up. In the 1960s, MIT professor Ed Thorp used the Kelly Criterion to systematically beat Las Vegas at blackjack. After the casinos banned him, he took the same formula to Wall Street. His fund, Princeton Newport Partners, delivered a 15.1% annual return over 20 years, with only 3 down months. Kelly wasn't just theory, it was Thorp's entire edge. Here's what most people get wrong. They think more risk always means more reward. Kelly proves the opposite. Past a certain point, increasing your bet size actually decreases your long-term wealth. The losses become too deep to recover from. To win big, size your trades to your edge, but never exceed the Kelly limit. And Kelly isn't just for trading. It's used in information theory for data transmission rates, in sports betting for calculating value in point spreads, and even in ecology, where organisms allocate energy between survival and growth. Follow Sovrun for more financial insights.